Good afternoon, everyone, and welcome to the second of today's sessions, where we're joined by Blake Hutchins, the manager of the Troy Income and Growth Trust. Blake's been co-managing the trust since October 2020, alongside his colleague Hugo Ure, who's been at Troy for more than a decade, and the pair run the portfolio with an active but conservative approach, aiming to deliver sustainable income alongside long-term capital growth. Troy as a house tends to place a great emphasis on capital preservation, and this trust is no different. And we think that makes it an interesting place to look at a time like this, when there's such intense volatility, with an uncertain outlook, and particularly when the yields available in the UK market are reaching levels which may be difficult to sustain. There'll be time for questions at the end, so please do submit those using the Q&A function as usual. But in the meantime, I'm sure you're very keen to get on with the show, and so I'll hand you over to Blake.
Thank you, Pascal, and good afternoon, everyone, and welcome to the Troy Income and Growth Trust presentation. As Pascal said, I'm Blake Hutchins of Troy Asset Management, and I'm co-manager of the trust. Today, I hope to convince you that owning high-quality, resilient UK companies in your ISA might be the way to go this ISA season. So let me crack on with the presentation and start by introducing those of you who are not so familiar with Troy to Troy Asset Management. We are an independent, growing boutique asset manager founded by our CIO, Sebastian Lyon. High-quality equity investing is at the very heart of what we do, and through primary investment research, we try to deliver a very, very clear return profile for our investors. Our ultimate ambition is simple and it's clear. It's to protect and grow investors' capital. Protect and grow, very much in that order. Now, we are a highly focused business. We believe in doing less, but doing it really, really well. We work from one global investment universe that is shared between all of our core strategies, which you can see on this slide, between our multi-asset offerings, our two global equity offerings, and also our UK franchise, which I lead. In our UK team, we are supported, or I am supported, by Hugo Ure, who's been on the strategy for the best part of 12 years. He's co-manager of this trust with me, and our senior investment analyst is Fergus McCorkle. And we're delighted that over the past couple of years, we've also been supported by Anna Kulkarni, an incredibly bright and talented young analyst. And it's a very complete UK offering that we have, where we are fully committed to UK equities. And you can see we have the open-end version of the fund, which is the Trojan Income Fund. We have the ethical version of that fund, which is the Trojan Ethical Income Fund, which has been going for many years now. And of course, we have our flagship investment trust, which is the Troy Income and Growth Trust, which I'll be presenting on today. Now, at Troy, as many of you may know, we tend to fly under the radar. We're not big advertisers, and you certainly never see us plastered all over London taxis. But one thing we do shout about is our passion and commitment for investment trusts. Troy has been privileged to have managed both, as you can see on this slide, Personal Assets Trust and the Troy Income and Growth Trust since 2009. And over these 13 years, the trusts have grown very substantially, as you can see, growing from quite small trusts in Personal Assets Trust's case to a very large trust today. And also on Troy Income and Growth Trust, it's the assets under management have the NAV of the fund has grown multiple times since we've been managing the trust. And we are committed to growth, and that is highlighted by the fact in 2020 we were absolutely delighted to add Securities Trust of Scotland to the Troy stable of investment trusts when James Harries was appointed global manager. And so now we have Personal Assets Trust, which is our multi-asset offering. We have Securities Trust of Scotland, which is our global income offering. And of course, we have the Troy Income and Growth Trust, focusing on defensive, resilient UK dividend growth stocks. And we are highly, highly passionate about investment trusts. Each trust is well known in its peer group for having low volatility compared to its comparator set, which is thanks to three things. First, our absolute approach to investing, in which we shun the index and instead we invest with an absolute mindset. Secondly, is our focus on above average quality assets and in particular on high quality equities. And then thirdly, we have a unique use of a discount control mechanism across all three of the trusts. And that's very important to us, which sees us issue and repurchase shares in order to ensure that you, our investors, pay and receive a price that matches net asset value. Moving on to the core of the presentation, which is specifically on the Troy Income and Growth Trust, let me take you through three sections. Firstly, what we've been doing for the past 13 years on the trust. Secondly, how we do it. And finally, why now might be a good time to look at the trust, particularly with license season in mind. So let's start. The Troy Income and Growth Trust is very much a focused UK equity savings vehicle that has about 80% of its net asset value in UK equities. We have a license to invest 20% internationally, and we use that. And we have a very clear and consistent approach that we as a team have been following for the past 17 years and have implemented on the trust for the last 13 years to great success. We dampen volatility through investing in high quality companies, and we provide dampening volatility and provide liquidity to our investors through the active issuance and repurchasing of shares to ensure that our share price reflects our NAV. And we have an important attractive dividend yield today on a historic basis of 2.6%, that's post fees, which in today's low yielding environment and investors wanting a secure and growing dividend yield, it is an important point. So the next three slides are absolutely key, and I'm going to take you through what we do, our aims for the trust, and who we think the trust is for. What we do is very simple. We invest in high quality, resilient companies that grow their dividends. High quality, resilient companies capable of growing their dividends. And in so doing, the trust aims to deliver for our investors market beating returns, but importantly with below market volatility and real dividend growth. So we have, over the past 13 years, very much delivered that. We have beaten the market in terms of our returns. We have delivered returns with lower volatility than the market, and we went through a period of very good dividend growth, which we have now recharged and expect to be able to achieve once again. So moving on to who we are for, and this isn't necessarily for me to say, but I very much have the end investor in mind when we put together the portfolio. We are definitely for the long-term saver. The beauty of investing in leading growing businesses is that you don't have to trade in and out of them, and nor do you have to trade in and out of the trust. We're a trust for long-term savers that may be seeking one of two things. First, for those that want income today, and there's a lot of retirees and people getting up to retirement age that absolutely will want an income and a secure income and a sustainable income in retirement. But that's not the only people who this trust is for. The second is for people that may want income at some point in the future and are happy to compound returns until that date. And then thirdly, it can simply be for those looking for a resilient, a defensive total return, and will maximize those total returns by actually reinvesting dividends back into the trust. And for me, when I think of each investor, all of those three investors, I tend to think about a member of my family. It can be for my mother, who wants to take income today in retirement. It could be for me, who will probably take income from the trust maybe in 20 years' time. Or it could be for my children, who are very young and want a defensive total return from quality companies, and will actually be reinvesting the dividend of the trust probably for the next 50 years to really maximize that total return. So the trust is very much for patient, long-term investors looking for any of those three things. And by definition, then, who is the trust not for? Well, since we are unashamedly long-term, since we avoid overstretching for yield, and since the trust is constructed very differently to the UK index, the FTSE 100, the trust, quite realistically, is probably not for those who want very high yield. We don't target high yield. It is not for someone looking to replicate the UK market. It's not for those looking to track the UK market day in, day out, week in, week out, year in, year out. And it's absolutely not for those without a medium-term time horizon. Dividend growth, not high yield, a highly differentiated portfolio when compared to the UK stock market. So that is what we do and who we do it for. Now let's look at what we've achieved over the past 13 years. Firstly, we've delivered above market returns, which you can clearly see by the blue line in this chart versus the red line. But importantly, it's the shape of those returns that are absolutely key. As you can see by tracking the blue bars versus the red bars in this chart, you can see that our returns can deviate very materially in any given year from that of the index. However, the pattern is very clear. Generally, we tend to fall less than the market in down years, and sometimes we rise less than the market in up years. And you can see both in years such as 2011, when you see that preservation of capital, 2018 as well, and actually in 2020, certainly in the first half of the year, when the market drew down because of the pandemic, you absolutely saw that resilience. And on the other hand, when we see a bounce back and a recovery in markets and leading to very strong returns for the market, years such as 2016 or even last year, we're quite happy to lag a very strong market on the upcycle. And finally, in terms of shapes of the returns that we generate, this chart highlights the fact that we've delivered not only above average returns, but it also demonstrates the below average volatility that investors within the trust have experienced over time. We have actually been the least volatile trust in the peer group, both since 2009 and over the past 2 years. Above average returns with below average volatility. Finally, in terms of the shape of returns that we generate, this chart highlights the 5 times that the UK market has actually fallen 15% or more since we took on the trust. Very clearly in blue, one can see shallow returns for the trust compared to the UK market in red, and also versus the income peer group in grey. This is something that's very important to us. Volatile returns that the peers have tended to generate, as you can see in grey, over these 5 market drawdowns, does not sit very comfortably with us or our approach. And so we're only too happy to stick to our approach to investing, which is emphasizing resilient dividend growth and leave high yield investing and more cyclical investing to others. So that's the first section of the presentation, in which we've highlighted what we do. Now let me give you an insight into how we do it. Our focus is very much on investing for the long term in a certain type of company, a company that generates growing, resilient, recurring cash flows from which a company can generate growing dividends. So recurring cash flows leading to recurring dividends. And to the end investor in that business, that's what's really measurable, those dividends that come out of those growing and recurring cash flows. Some of the types of companies well suited to doing this are highlighted on this slide. Firstly, repeat purchase consumer good companies. I don't know about your house, but we tend to get through a never-ending supply of PG, Pampers, nappies in our house, Vanish stain remover, Finish dishwasher tablets, and a decent amount of Fever Tree tonic as well from time to time. Repeat purchases funding repeating dividends. Subscription software companies, as you can see top right, such as Relex in the UK, or the US HR and payroll software company Paychex, both produce highly resilient cash flows and dividends. The likes of Croda, bottom left, which we will talk about later, and Diploma, bottom left as well, are industrial niche companies in the UK that supply their customers with vital but low-cost products. And finally, bottom right, we like contracted inflation-linked income growth from the likes of London Metric, or some of you may even be customers of self-storage companies like Big Yellow or SafeStore. So as you can see from this chart, a diverse collection of companies with recurring cash flows and recurring dividends that pay those dividends to our investors. The key way in which we minimize volatility and have been successful at avoiding permanent loss of capital is by being very focused on what we will and also what we won't invest in. As this chart shows, the more capital intensive and cyclical a company is, the less likely we are to be interested in that company. Really, we do not like this combination of heavy capital intensity and heavy cyclicality. And as you can see from this chart in red, there are companies and sectors that we simply will not own. We do not own oil companies, miners, banks, life insurers, airline companies. And as you can see in red, these are the sectors and the companies that we tend to avoid, whereas we very much are drawn to those companies in green. The more less capital intensive, the less cyclical a company is, then we are drawn to those. And you can see some of those companies in green here, and many of them are the ones that I've highlighted just on the chart before. And that leads us to a very distinct portfolio of high quality, resilient companies capable of long-term dividend growth, and a portfolio that is actually very different to the UK market. The UK market, as we know, is loaded full of the kind of companies that often we don't invest in, companies such as HSBC, Vodafone, Rio Tinto. And the best way to get a sense of the portfolio and what you ultimately own by being a shareholder in the trust is to look at this wagon wheel, or this pie chart. And if I just take you around the pie chart in clockwise fashion, you'll get a really good sense of the exposure within the fund, within the trust. Starting with purple, 25% of the portfolio is in consumer staples for the reasons we've spoken about just before. 25% are in data assets like RELX and Paychex. 15% in consumer stocks like Compass Group, or the franchise companies, Domino's Pizza and IHG, capital light companies that are very cash generative. You can see 10% or so are in niche industrials, 8% in property in orange on this chart, 8% also in healthcare, both pharma and medtech, 7% in financials, which is very small compared to most income funds by virtue of the fact we don't like cyclical companies, and about 6% in infrastructure and utilities. So taking a step back, hopefully that gives you a very good idea that we have a portfolio of resilient, pretty predictable, high quality companies capable of dividend growth. Moving on to the top 10, our largest holdings very much tend to be those that are most resilient and most dependable. Many of these companies are household names. You will recognize them, and many of them have fantastic track records of delivering resilient returns. 45% of the trust is in the top 10, and many of them are global leaders in what they do. Now, beyond the top 10, there are 32 further holdings. Some of them are slightly smaller than those that are in the top 10. We tend not to be very small or mid-cap focused, but we do have select quality companies that are slightly smaller. And then we tend to position them at smaller weightings within the portfolio. And remember, 80% or so of the trust is in UK stocks, and we have a license to invest 20% overseas, which we think is a unique feature of the trust, and we very much take up. To finish off this section of how we do it, I wanted to dig a little deeper on two companies that we've owned in the trust for many years, and also give you an insight into two companies that are slightly newer that we bought in the trust around 2 years ago. So let me start with Experian, which you can see on this slide. Experian is one of the world's largest information services companies, known for having built up decades worth of data on thousands of companies, on literally millions, actually over 1 billion consumers around the world, which they then analyze, sort, repackage that data in order to allow consumers better access to credit, in order to allow companies to better assess creditworthiness of consumers. And they have a dominant business, not only in the US, which is something we very much like in businesses. We very much like the US market. They also have a dominant business in Brazil and here in the UK, just to name a few of the markets that they operate in. We tend to think of Experian as the UK's best technology company, and it doesn't get talked about in that light, but we struggle to see one that is better, and it stacks up very well with the best-in-class US technology and data companies. You can see the total shareholder return in blue of Experian, and thanks to both strong growth, very good structural tailwinds that the company benefits from, and attractive economics, Experian has delivered a fantastic total return. That is to say, a combined price and dividend return of 283% since we have owned the company in the trust, which, as you can see, far outstrips in red the return of the market, which is 115% since that 2012 period. Next, moving on to another stalwart of the portfolio is Nestle, a company of an owner of much loved brands, including confectionery brands such as Kit Kat, but also some of the newer businesses that they've built over the past 10 years that are really driving returns for the company, such as Nespresso coffee, and also the fact that they own some premium pet care and pet food brands. And given the global pet craze, which I'm sure many of you have witnessed either yourselves or on your walks out and about, Nestle are very well placed to continue to capture growth there. Nestle has been in the trust actually since Troy took over management of the trust in 2009, and as you can see on this chart, has delivered wonderful total shareholder returns, driving both capital growth and dividend growth. In terms of newer holdings, let me turn to Croda, which we purchased about 2 years ago at what was, in hindsight, a very good price. For those of you who don't know, Croda is a British business. It's a specialty chemicals company based in the north of England, but with presence globally. They supply absolutely vital ingredients to their customers, the likes maybe pharmaceutical companies or L'Oreal or Procter & Gamble or Estee Lauder. And they usually provide chemicals in very small quantities that go into, for instance, anti-aging cream, biologic drugs, and actually even go into mRNA vaccines such as the COVID vaccine developed by Pfizer to great effect. Croda has an over 30-year track record now of growing their dividend every single year. It's a very elite company in that sense. And as you can see in this chart, which looks at the dividend per share of Croda over that period of time, over those 30 years, they have averaged 9% compound free cash flow growth, which has driven a dividend growth of 9% as well. So once again, you can see free cash flow growth really driving dividend growth. It is the only source of long-term dividend growth. And Croda also have a fantastic management team who do a great job for shareholders. Finally, on how we do it, let's just take a look at Diageo, another holding that was bought about 2 years ago at a discounted price during the pandemic. Diageo are owners of some of the world's best spirits brands, from Johnnie Walker to newer brands such as Casamigos Tequila, the George Clooney founded brand, which is doing incredibly well over the world, but particularly in the US, really driving that craze or that trend towards premium spirits, for which Diageo is incredibly well placed. Spirits are taking share from beer and wine, and Diageo are very well placed to benefit from that. Again, you can see in this chart metronomic free cash flow growth, which has averaged 8% over the past 22 years over many different conditions, and this has led to compound annual dividend growth of 6% over the same time. And you'll notice Diageo today is the biggest holding in the trust, and needless to say, we're very excited about their future growth prospects. So that's not only what we do and how we do it, and now let me move on to the final section of the presentation, which is considering why now. Why might the trust be relevant for your ISA, those ISAs that you manage. And whilst what we do on the Troy Income and Growth Trust and how we do it remains very constant, the world around us is shifting and prices are shifting very fast at the moment. This year to date has seen dramatic price moves, as you can see in this chart. Here we show returns from the various sectors within the UK market over the very short period of January and February of this year, with commodity prices taking off, and which is for various reasons, not least due to the tragic invasion of Ukraine by Russia. The only area of the market that has really seen very positive returns year to date has been from oil and mining companies, and this has very much been to the detriment of more growthy, more stable businesses, the likes of which we invest. You can see on this chart quite that dispersion of returns, where at the top of the chart, energy and materials deliver very strong returns, and more stable businesses such as IT and even technology and consumer staples have delivered negative returns. And with such extreme polarization happening in this very short period of time, that provides opportunity for us. returns or periods of returns like this tend to be episodic in our view. And so with prices that have come down and business prospects that by and large are still very strong and really haven't altered all that much at all, we are getting increasingly excited about the opportunity set. As a reminder, at Troy, we invest from a global universe of 170 companies that we research in depth, and we are starting to see opportunities emerge. Here I've bucketed some of these opportunities between companies, firstly on the left-hand side, in which we already invest, such as Diploma and Croda, and also in the middle, for those companies that we know very well that currently sit on our global investment universe, in which we've been waiting for better prices and now very much coming into range. Companies like the distributor Bunzl, or probably one of the highest quality companies in the UK market, Spirax-Sarco, are getting much more into our kind of territory in terms of valuation and dividend yield. And then finally, on the right-hand side, we're always on the lookout for the dividend growth stocks of tomorrow, of the future. And so the final bucket of companies is where we're doing ongoing research in companies like Rentokil and Ferguson, both businesses that have very strong positions in the US, resilient quality companies that frankly we feel are being overlooked for commodity companies at the moment. And we think these more defensive, resilient companies are very well placed to come to the fore as macro conditions get more challenging. Now, let me just finish with leaving you with a sense of an overall sense of how the trust stacks up in terms of some metrics that we like to look at. So in terms of quality, in terms of growth, and in terms of yield or valuation. This is a lens through which we look at companies, and it's also a lens through which we reflect on the trust and the portfolio and the funds that we manage. Starting with quality, rest assured, and you can see on the left-hand side, we are investing in companies that have significantly better profitability and quality metrics than the UK market as a whole. Operating margins of on average 20%, returns on invested capital well into the teens are probably double that of the wider UK market. In terms of forward growth, this is a very important component of long-term dividend growth, of long-term returns. And you can see this is not to be taken too literally because this is only forward-looking data from consensus. But it's safe to say that good sales growth of over 6% over the next 3 years on an annual basis should translate into very strong earnings growth for the trusts, companies and the overall portfolio as we look forward. And finally, and this is where we're getting more excited, with regards to yield, and if I start with dividend yields at the portfolio level, a 2.8% dividend yield, which is very well covered by our earnings yield of nearly 5%. And seeing that coverage, seeing that cover of 5% covering 3% is really important. We don't like to strive too high for dividend yield. We would hate to see a dividend yield that exceeds our earnings yield or even nudges up against our earnings yield, because ultimately we want our companies not to pay out all of their earnings as dividends. We want them to reinvest a portion of their earnings to reinvest back into the business. And why wouldn't we want them to do that when they have growth opportunities, as you can see on this chart, and they reinvest at very high incremental returns on capital, which ultimately drives long-term growth, long-term dividend growth, and ultimately total shareholder return. So we very much like this combination of high quality, good growth, and then prices that are very reasonable. And it's that combination that has very much delivered resilient returns over the past 13 years. And we think positions the trust quite well to do so over the next 13 years. On that, and as I come up to my half hour, I will leave you with 3 key messages. The first is that the Troy Income and Growth Trust is very specifically a quality-focused equity investment trust with a 13-year track record of investing for resilient dividend growth. The second point is that given the world in which we currently live and invest through, we should expect volatility, certainly in the short to medium term. But given valuations that are increasingly compelling and that we invest in highly defensive, resilient businesses, we do believe that the trust is a very good place for your ISA this year. And third and finally, we're in constant contact with our companies. We've had a lot of good updates with them. We really do believe that our companies are in great shape, not just for the short term, but very well placed for long-term dividend growth as well. And with that, I thank you for your interest, and maybe Pascal, I can turn it back to you to see if we have any questions. Thank you.
Definitely. We've had a few questions come in, so straight into those. With both open and closed-ended funds in each strategy, how does Troy differentiate between them? And how do you avoid the trusts being hit by selling in shares in the open-ended funds when trying to meet redemptions? Or I think basically, is there any overspill when the open-ended funds are being sold into the shares of the closed-ended funds?
Okay, thank you. So 2 points there is differentiation between the two. Now, clearly, we really like the investment trust structure, and I think there are a few differentiating factors versus the open end. The first is the size of the trust. The open-ended strategies are the best part of 3 billion, and the smaller mandate size, the smaller size of the investment trust gives us a bit more flexibility. We therefore have very slightly more mid-cap companies. We have very slightly more overseas exposure, and so that's the first point. The smaller trust gives us a bit more flexibility, and expect us to use that going forward. The second is the ability to smooth dividends, and again, that will be a feature that we'll be able to use over the coming decades on the trust. Having rebased our dividends and recharged our dividend growth, you should absolutely expect we expect the dividend to show very healthy upward progression over the medium to long term, and to be able to, should we ever have to use it, which maybe we won't have to, but to use that smoothing of dividend. The third point is that we do have an ability to gear the trust, which we obviously can't with the open end, and we're very open-minded to that, and particularly, and I think hopefully I've given you a good account as to the fact that valuations are moving in our direction, and given the resilience and the low volatility of the trust, don't be surprised to see us gear the trust as well. So those are just some of the differences between the open end and the closed end. On the open end, and if we've had redemptions, I'm pleased to say that it's been a really good test case, because having attracted a lot of capital, having protected capital very well during the pandemic, we've actually been not so much over the past 6 months. We did go through a period of outflows, and you will be very pleased and hopefully reassured to hear there has been no spillover effect. We don't invest in illiquid companies. We're very conscious of liquidity. It's very important for us that we're as attractive for investors who've been in the trust and the funds for decades as we are for new investors. And so you should take a lot of reassurance that by virtue of the fact that we invest in liquid companies, that we manage these risks very actively, that there has been no spillover effect from one to the other.
Thank you. Can you tell us a little bit about whether the dividend is covered by income reserves, and what the policy is in terms of those reserves, and how substantial they should be?
Yeah, absolutely. So as I said, one of the nice features of investment trust is that ability to smooth dividends. Investors will know that by virtue of the fact that we've been pivoting the trust over the past 3 years into dividend growth companies and away from some of these UK companies that have really run out of road in terms of dividend growth, we took a rebasing of the trust dividend about 18 months ago, and that has been in order to reflect the economic reality of making sure that we're in companies that are very, very well placed to grow from here over the long term. The result of that is that we do currently have a very slight revenue shortfall in terms of covering our dividend. But the good news is, when we look at our companies, there's very healthy dividend growth within the portfolio. If you think about some of our largest holdings, I think Croda's just grown their dividend 10%, Experian will grow their dividend 10%, Diageo just grew their dividend high single digit. There's an abundance of dividend growth within the portfolio, and so don't expect it to be a long-term issue that there's a shortfall. And that's ultimately what the investment trust structure is good at. And so over the medium term, absolutely expect cover to resume, and there is healthy revenue reserves, not to mention capital reserves within the trust as well.
There's a few more questions about the income, which I think sort of follow on quite nicely to this. Do you use any kind of derivatives, either to defend the capital, as part of your absolute return kind of facing, or to enhance the income itself? And do you use any income? Do you pay any income using capital?
Yep. So the first one is an easy one. We don't use derivatives or the like. We very much like simplicity, and our overall policy, and we're very big on this, is ultimately we want the dividends that the trust pays to reflect the economic reality of the companies that we invest in. So very broadly, if you think about the fact that the portfolio's dividend yield is 2.8%, for £100 invested, there's about £3 of dividends being produced by the companies that we invest in, which is very well supported by the earnings that they generate. I showed that chart. For £100 invested, there's that 5%, there's that £5 of earnings covering about £3 of dividends. We want that to reflect the dividends that the trust pays out. We don't want to get to a situation which you see with other trusts where perhaps they're generating dividends of, let's say, £3, but paying out a dividend of £4. We don't like that, and don't think that's sustainable over the medium to long term. So the short answer on the first one is no. We do not make up for dividends through derivatives or the rest. And the second point is that, as I said, there is currently a modest shortfall between revenues and dividends as companies grow their dividends into the medium term, into the next couple of years, but also as companies return to paying dividends, having foregone dividends over the past couple of years. I think this is a really good chart just to emphasize what's happening underneath the bonnet and what will ultimately come through to investors over the next few years. These are all of the companies within the trust, and looking at their dividend, what we expect them to do in their dividends in the year ahead. And we expect 37 companies to grow their dividends this year. We cautiously expect 2 to hold them flat. There will be one dividend cut, which I think is quite well telegraphed, is GSK. And the good news is 2 companies which had to forego their dividend during the pandemic are coming back to paying dividends. IHG is one of those, Compass Group is the other. And so on a forward-looking basis, which is the important point, our companies are very well placed to deliver dividend growth, and that will come through to investors over the medium term. The final point I would say, just in terms of dividends, you may have a question on this, Pascal, but let's just remember where our yield is. It's about 2.6% on a historic basis. That's net of fees, and you can see we stack up very well in terms of dividend yield versus most asset classes. We're still in a world where a lot of government bonds yield very little indeed. We're in an excess. Our dividend yield is a premium to the MSCI World, a premium to the S&P 500, a premium to the FTSE 250. And whilst it is below the FTSE 100, that's very much because a lot of dividends are currently being paid by banks, oil and miners. And as I said during the presentation, we don't invest in those companies. And so we think it's a slightly skewed comparison. And we're quite happy to have a lower dividend yield that's much more, we think is very sustainable and able to grow, as opposed to overreaching for high yield.
It's just a very simple answer to this one, I think. But do you invest in private markets at all, or is it all listed equities?
All listed equities.
Yeah. So another interesting angle that's coming through from various questions is about the nature of the return the portfolio offers. And given your kind of conservative approach and the absolute return angle that you've got, although I want to stress it's not an absolute return fund per se, how should investors expect the fund to perform? Does it affect its ability to stand out versus its peers? And how does it affect its ability to perform when the market is in a very strong growth phase, as it has been quite often in recent years?
Yeah, I think that's a fair point. I mean, the nice thing about this trust is we have a 13-year track record of that we can compare, and across the income funds we have a 17-year track record. And I think it's very insightful. If you were looking at the open end and you added the financial crisis, you would have seen very strong markets ahead of the financial crisis, and then obviously very weak markets during the financial crisis. And leading into the financial crisis, our strategies underperformed, and they massively outperformed in more tricky markets. And so when we look at years such as 2011, when the market drew down and we delivered a positive return, years such as 2014 and 15, when the market barely delivered a return and we delivered a positive return, that's very much in keeping with the kind of return profile that we've done historically. And then the flip side to that, because we don't rotate, we don't shift the portfolio that much, don't be surprised if we lag a very strong upswing, such as 2016, 2017. And that's very much been shown over the past couple of years. 2020 is not really that helpful in showing that. Whilst we did protect capital better than the market, if we had cut that off at the half year when obviously the market was very weak, you would have seen a huge divergence between our returns and the markets. And then the market was very pro-cyclical as we saw that vaccine rally come through. So just to manage expectations, look, no cycle is the same, no drawdown is the same, and this is by no means a guarantee that we can continue to do this. But just intuitively, when you think about our reliance on growing businesses, on defensive businesses, I think it's pretty clear that the kind of market conditions that suit us, and on the other hand, the kind of market conditions that won't suit us. And so with 50% of the UK market in banked oil and miners, for the best part of, I think it's 35% in banked oil and miners, and we don't own a single bank, a single oil, a single miner. When those companies do very well, when there's a commodity rally, don't expect us to participate. But on the other hand, when market conditions are more neutral, that's where I think quality compounding, or even when markets are more in recessionary mode, again, that's where quality compounding, resilient businesses come to the fore.
Good stuff. Another one sort of related to the whole performance and the kind of investment process when it comes to performance is there's an example of a company in your portfolio here, Paychex. Somebody has brought up, and they say it's trading in a PE of 33 times earnings. What's your policy on selling after a strong run? Is there a fixed policy, or does it, how does it work?
Yeah, it's a good point. Paychex has been a fantastic investment for us over the past couple of years. And just for those of you who don't know, Paychex is a software company that produces that supplies HR and payroll software to small and medium-sized businesses, specifically in the US. You can think about it as almost outsourced HR function in some instances, and then also that software that ultimately pays millions of employees around the US. And Paychex has really benefited from the digitalization of software, of payroll. And it's fair to say that the valuation at 33 times earnings is, or 32 times earnings, I think it's about 32 times earnings, is a premium to what it has been in recent years, which is probably more like 25 times earnings. So look, Paychex today is probably not one that we're adding capital to. You'll notice it wasn't on that opportunity slide that I highlighted, but the bigger picture is Paychex, I think, has grown their dividends for 30 plus years. It's got a great prospective returns in terms of its ability to grow free cash flow, and probably the best part of double digits for many years to come. But I think it's fair to say, we're in the mode of selling a few rather than buying a few, but we absolutely are going to remain invested in Paychex.
Yeah. Two more questions. One is, what part does ESG play in the process, and is there any kind of explicit ESG policy?
Yep, there is. We don't differentiate between the different funds or trusts in terms of our approach to ESG at Troy. Rather, instead, we have a very, very integrated and important ESG approach across the whole firm. And you will notice, because of our big emphasis on the way that we invest, a lot of research, really believe in governance. We interact with companies, we vote all of our proxies, we engage with companies on a regular basis, always have, and we absolutely are adopting the climate change initiatives that are so important for transitioning our economies to a sustainable basis. And whilst we're not explicitly an ESG fund, by virtue of the kind of companies that we invest in, we are very well placed for that. And here's just an example. You can see in blue, this just looks at carbon intensity, the carbon intensity of the fund versus the market. is a fraction of the market in red versus our line in blue. And also, very importantly, our companies are not only far less carbon intensive, but they're also decarbonising at a faster rate than the market. So not explicitly an ESG fund, but it is absolutely central to the way that we research companies across all of our products and trusts. And so people do actually use us for an ESG fund, even though we are not explicitly an impact or an ESG focused fund.
Great stuff. Last question. Do you or the board have any of your own invested in the trust? Have you got skin in the game?
Absolutely. You can see here the team. This is the board and the trust. We have a very clear remuneration policy at Troy, where we defer a lot of our compensation over multiple years, and we own, with that deferred compensation, we have to own either shares in the company, Troy, which I very much do, and we have to own stakes in the funds that we manage and Troy funds. So it's safe to say that I absolutely have skin in the game in this investment trust, as does all of the board. I think that's public information, and you can even see it in everything that we do.
Great stuff. I'm afraid that's all we've got time for in terms of questions. So thank you very much, everyone, for submitting so many. Thank you, Blake, for answering them. Our next presentation is at 1 o'clock with BlackRock Latin America. If you haven't registered for that yet, there's still time to do so. You can just look at our homepage, and you'll see all the sessions on there, and you can sort of log in that way. There were some questions about the discount control mechanism. If you look at Troy's page on our website, trustintelligence.co.uk, you'll see there's a discount section. That kind of question is answered in there, so that's why we've not gone through them. So thank you very much, everyone, for joining us, and thank you, Blake, very much for taking the time to be with us today.